Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. This is a weekly live stream, which technically is a live Q&A, but where we're going to be exploring issues to do with private equity and indirectly the structure of corporations and companies and how they operate and how everything works at that level, which is something you don't often hear about. I'm interested in this topic. It concerns sort of my past and some of the positions I've had, but I also believe that a lot of these concepts can come downstream and can benefit people at lower levels, whether you're an entrepreneur or even if you are in just a regular job or in a management type position. Knowing of this stuff can help you and can apply directly to you much more than you would think. So that's what we're going to be talking about today. So as always, a special shout out goes out to my YouTube channel members, my Patreons, my super thanks donors, and to you for joining me, my participants. Thank you very much for being here. I see there's 13 people here. The title of today's episode, this is episode number, what are we here? I don't have it recorded. Oh yeah, here we go. Episode number 5. And the title is, Who Decides CEO Pay? So we're going to be talking specifically about compensation committees and stuff like that today. Just doing a brief overview of that and some of how it all works and how they do compensation at that level. This stuff directly applies to things lower down or on a small scale, because it's a question of how do you get someone to run something the way you yourself would run it, assuming you own it, right? So if you own something and then you want to put someone else in charge of it, how can you ensure that they care about it in the same way you do? Okay, that's been a major issue with this kind of stuff. This is technically the world of governance and incentives. And it's not something that they really deal with that much at a lower level, which kind of surprises me. I understand why they don't deal with it at a lower level, because of convenience, you know? It just doesn't seem like it's worth putting thought and time into. But actually, the issues that this stuff is designed to prevent ends up being big issues at lower levels. So maybe people should think about this more. Anyway, let's get into it. So I'm going to do my spiel and talk about this topic. And I'll be taking questions towards the end. If people have any questions about any of this stuff, I'll see if I can help you out. Okay, let me start by saying that this is sort of a very big topic. It applies to all kinds of organizations. If you are a organization that has a CEO or any kind of manager being in charge of it, this applies to them. This also applies to anyone on the compensation committee or the executive management committee, which is like the executive managers of an organization. And there's no line in the sand as to what constitutes an executive. It's just someone in general who has a large area of responsibility and has some say in the strategic direction of the organization. Okay, they are allowed to make strategic decisions or participate in them. But beyond that very vague definition, there's no clear definition of what makes someone an executive manager and what doesn't. You know, that's really the broad definition. And whether you're talking about a small private corporation or you're talking about a large publicly traded corporation, this stuff varies. So it's going to be very hard to pin it down. I'm going to be talking today within the context of a smaller private corporation, because I think that applies most generally. Okay. So we're going to talk about that. So who decides CEO pay? Who is the boss of the CEO? It's very simple. The board of directors is the boss of the CEO. It's very simple. The CEO reports to them. They have the power to hire and fire the CEO, and they get to set the CEO's compensation. So that's how this works. The CEO might be the most senior manager in charge of some kind of business unit, but they don't have the powers of God. They usually don't own the business unit, so they report to the people who do. And the people who do are the shareholders. And like we've covered in the first 4 episodes of this series, which is kind of a bit of an experiment so far, we talked about, how that ownership structure works, where you have ownership is basically a number of shares for our purposes, and you might have several people that all own shares of a corporation, and they elect directors to represent them, because it may not be possible to get all these shareholders around one table and able to have one conversation about what to do, right? So you elect directors to represent you, and the directors collectively, they do 2 things. They run the organization and they oversee the CEO, right? So there you go. They run it in the sense they represent the shareholders. Anyway, we covered all that before. The bottom line is that the board of directors, they are the boss of the CEO. And they also can be the boss directly of other senior officers that are managing the corporation too. So everything I say about setting CEO pay also applies to the other C-level officers, like the chief financial officer, chief operating officer, are usually the big ones. They can report directly to the board, and the board can set their compensation and all that kind of stuff too. Okay, so the board has responsibility for doing this. Now, usually the way it works is that the board establishes some kind of committee, okay, which they are tasked with doing, specifically overseeing CEO compensation and overseeing CEO performance, okay? And usually they call that the compensation committee. Okay. Now, once again, this stuff is pretty loosey-goosey because depending on what country you're in, depending on the size of the organization, and depending on whether it's publicly traded or not, if it's private, there are different laws governing, whether you require separate committees and how they're supposed to operate and who can sit on them, like what credentials and things they need to have. And if you need an external auditor or external participants in those committees also. So that stuff really varies. This is the problem, okay? But usually within smaller corporations, where I am in Canada, you do have some form of audit committee. Sometimes it can be informal. It can be just part of the board of directors. They do it at their regular meetings and stuff like that. Or it can be a separate subcommittee that's made up of a subset of the directors. Okay. Sometimes there's legal requirements that, the people that are on the audit committee, they have to have certain things in terms of financial literacy. Either they have to have certain credentials in accounting and finance and that kind of stuff, or they have to have financial literacy, where they might not be an accountant that's certified, but they still are competent in analyzing financial statements and this kind of thing. So once again, the rules kind of vary, but that's the general idea. And the compensation committee is tasked with obviously setting the compensation of the CEO and verifying, doing the controlling function to see if the CEO is performing as per requirements, and therefore how that affects their compensation. So that's kind of how these things are set up. Wow, there are 17 people here. Thank you for joining me today. I find this stuff, I find I'm not doing a job of making it really come alive so far, but we'll see. Okay, so far we covered who's on the compensation committee and what they do in general. Let's talk about some of the more specifics. This is the stuff that I find a bit more interesting. So, okay, most people are probably familiar with, if you've ever had a corporate job, right? And you look at how you are compensated. Usually your pay package has more than one component in it, right? You might get, for example, a base pay, where you get paid for showing up at work, right? It has nothing to do with your performance at work. It has nothing to do with anything being conditional. It says just for being an employee and showing up, you get this pay, right? That can be a wage or a salary, right? Then, in addition, you might have other tiers of your pay package. So you might get performance pay. And this can come in the form of like a bonus. If you do something well, like your boss sets some kind of a target and you meet that target, then as a reward, you get performance pay that you could get, but it is not guaranteed. It depends on your performance, right? And this can take various forms. It can be based on your personal performance, or it can be based on the performance of your group, like maybe your work group or your division of the company or something. Or it could be based on the company as a whole, right? So, in that case, all the employees would get a company-wide performance pay that's based on the performance of the company. And, it affects all employees. So all of that is performance pay. It can be tied to you, a group of people, or the entire company. That's usually like a second sort of tier, right? In addition, you probably get benefits of some kind, right? Or that's common to get benefits of some kind. And benefits, the definition is anything they give you that isn't cash, okay? So, for example, instead of giving you cash, they say, we are going to, pay a doctor or something so that all your medical bills are paid for, right? Now, that's still not cash, right? It's not the same thing as getting cash, because with cash, you could spend on anything you want, right? You don't have to use it to pay for a doctor. You can use it to pay for whatever you want. That's the magic of getting cash, right? They're giving you something other than cash. They're saying, okay, well, we're going to pay all your doctor bills. So it's like, okay, it sounds like cash, but it's not cash, because what if you don't have any doctor bills? That's kind of useless to you, right? It's tying your hands. You can't just take that money and reallocate it to something else, right? So anything they give you other than hard, cold cash is considered a benefit, right? Even if it's something very, very close to cash, we will give cash to this particular thing of yours, right? That's still not cash. So those are benefits. They're like everything that doesn't involve direct cash, right? Then there's something called perquisites, usually abbreviated to the word perk. Okay, I'm getting a perk. And that's something that they give you technically as part of your job. But let's be honest, everyone knows that it's something of value in itself, right? So if they say, okay, we're going to give you a company car, right? That's great. Technically the car is for you to do your job. But if you were to take that car home on weekends and use it to go to the beach or something, I don't know, that's you're also getting personal value from that thing too. So it qualifies as a perk. Okay, so as you see, like some of these tiers start stacking on top of each other. There's multiple layers here. Okay, now what I've mentioned so far are things that a lot of people are probably familiar with, even though you might not be an executive or ever has worked as an executive manager. Okay, you probably may have gotten this or some of these in your pay package, your compensation. If you're in the middle or you're at the bottom or you're somewhere in between, right? Now, when you're dealing with executive compensation, that a compensation committee would do for the CEO, they go into other areas too. Okay, so for example, one of them might be some kind of equity type thing where they give you shares, right? So instead of giving you cash, they give you shares. And they can do this under many, many different circumstances. So it gets very complicated. It gets to the point where you need a degree in finance to understand a lot of this stuff sometimes, okay? So let's get into some of these. Okay, I mentioned base pay, and we talked about performance pay. Now, the other thing about performance pay is that you can break it out in terms of short-term incentives, medium-term and long-term incentives. So usually, anything less than a year or up to 1 year is considered short-term. So your boss might say to you, okay, here's a performance target for you. And if you achieve that target, you get this much money as a bonus at the end of the year. If you achieve not quite the full goal, but maybe half the goal, then you get this much money. And if you don't achieve that, you achieve this, then you get 0 or something. So a lot of general employees will get short-term incentives, meaning like 1 year or less, usually the 1 year thing. We see that for like a lot of professional jobs. If you hit this target, then you get this. And obviously the incentive is for the employee to care and try and do their job well. Because if they do, then they get this extra pay. That's the idea, right? So for executive pay, what they do is they break that out into short-term, medium-term, long-term, okay? Now, one of the problems with having a manager run a business on behalf of the owner is that the manager doesn't care about the business like the owner does, right? I mean, the owner presumably cares about this thing long-term. Presumably they want it to grow steadily over the long term, right? So that in 20 years, the thing is still around and it's doing well and it's even bigger than it was before, right? If you are a manager that's been hired to run that on behalf of the person who owns it, you may not care about what happens to that thing in 20 years because you figure, long before then, I'm going to be out of here, right? So, the problem is if you put that person in charge of your business or whatever it is, they will tend to think in terms of short-term gain. And they won't really care that much about long-term performance, right? So one of the mechanisms that a compensation committee has to align the interests of the manager, in this case the CEO, is to provide long-term compensation that gets vested after a certain amount of time or a few conditions are met. So what that means is that, they, if you're the CEO, they pay you and they say, okay, here is your performance expectations. We expect you to hit this target, okay, in terms of like financial performance or certain goals, like market share and things like this. We expect you to hit that. And what we're going to do is we're going to pay you bonus pay. We're going to give you performance pay, but that performance pay is going to be something that you don't get now. It's something you get in 5 years. And there can be additional conditions. If you leave the company before then, you forfeit those payments in 5 years' time. If you're not here anymore, they only apply if you're currently employed. They could also say, well, we are going to give you a short-term target, okay? And if you meet that target, you get this pay. It's yours. However, what we're going to do is we're going to hold on to it for a while, and we're going to give it to you in 5 years. Okay, so that means you have to stick around for 5 years. If the company doesn't exist in 5 years, then we obviously can't give you that pay, right? Things like this. So there's a lot of different arrangements where they can do this. And the whole point of this is supposedly to get the manager to care about the long-term performance of the organization the way an owner would. That's the idea. Okay, so there's all kinds of permutations of this. They do it all kinds of different ways. Sometimes it can make your head spin. But this is called deferred compensation, right? And they tie it to all kinds of things. Now that's just cash, right? That's pay. The other thing they can give out are shares. So they give you equity, which is an ownership in the organization, in the corporation. And this is also done a variety of different ways. For a start, they can simply give you the shares as if it were cash. They could say, here, instead of giving you, $10,000 or something, we're going to give you X number of shares. There you go. That's your pay, right? So this could be another tier of your pay package. Then they could put all kinds of conditions on it and say, well, we'll give it to you in 2 years or 4 years or whatever it is, right? That's one sort of tier. Another thing they do that makes it even more abstract is they don't just give you the shares. They give you an option. And this is where it starts to get complicated for most people, is that instead of giving you the shares, they say, we will give you a deal on the shares. So it's almost like giving someone a coupon and saying that, here, this coupon is very valuable because it allows you to buy something that's presumably worth this much, right? But you can buy it if you show this coupon and only pay this much, right? So it's like we're giving you a really good deal on it. And the idea is that if you had that coupon, you could buy this thing that's very valuable, like a few shares, and only pay this much for them. So you're getting a good deal. Presumably, what would that be useful for? It's so you can turn around and then sell your shares that you just got. You just paid this much for them, but now you're selling them for this much, so you're making a huge profit on them, right? That's the implications of it. So they're not giving you the shares; they're giving you like a coupon, as it were, to get a good deal on them. And it just branches out from here. They put all kinds of conditions on these things. They say, you have to hold them for a certain amount of time. And the idea is that, first of all, if the company's bankrupt, the shares are worthless, right? So if you bankrupt the company, all this compensation we're giving you is worthless. It doesn't matter. You now have all these shares of a company that they're worth zero. Big deal. So this gives you an incentive to not bankrupt the company. More than that, it gives you an incentive to make sure the company is worth as much as it possibly could be, so that those shares are highly desirable, right? So that's kind of aligning your interests with caring about the company, making sure that it performs well over the long term. And even if you yourself have left the company, you still have an incentive for that company to be worth a lot and be doing fine when you leave and not collapse shortly thereafter, right? We don't want you to set the company up so it's really valuable, but as soon as you leave, when someone else takes over, they discover you've set everything up so that, things just collapse like a bag, and the next person is the fall guy left standing, and, they were set up because you sort of manipulated things so that, it looked really successful, but as soon as you left, it was revealed that things were not as successful as they seemed, or something like that, right? That's the idea. So this gets really complicated. I'd like to do a live stream on options if anyone is interested in options, all the different types of derivatives, that kind of stuff, if anybody cares about that stuff. So you always hear about, usually you hear about that stuff when there's a financial crisis or a problem with the economy. That certainly happened in 2008, right? Or there's big corporate scandals or something, and that's when you usually hear about this stuff in the news. So if anyone is interested, I'll probably do an episode on that, just on the off chance that people care. Okay, so we talked about shares, we talked about options, rights. What else is there? We talked about perks, talked about benefits. You get benefits the way any other employee might get benefits, right? They also put other things in the employment contract for CEOs and executives. Non-compete clauses are common. Non-solicitation clauses are common. For those who don't know, a non-compete is, to say that you won't leave and go to a competitor or something. Okay, they want to make sure that doesn't happen. Taking all that, insider company knowledge with you and then you go work for a competitor, that would be bad. And non-solicitation means that, when you leave, you're not going to take a bunch of key employees with you to a competitor or another company, right? So those would be very damaging. So they put all kinds of stuff in there to just make sure that you, on the whole, will behave in a way where you care about the long-term performance of the organization. That's what all this is for. Okay. There's two more things that I'm going to cover when it comes to the compensation package, some of the stuff in there. Some common things are called golden handcuffs. I hate all these slang terms, but that's what they call it. That's where, all the stuff I talked about with the long-term incentives, the things that make you want to stay there and want to care. Usually the things that make you want to stay in the role, those are referred to as golden handcuffs sometimes in some circles. And if you do leave, like for example, let's say that the organization was acquired, right? And this directly relates to private equity, which is the overarching topic of these live streams. If the company is acquired, you got two companies and they sort of merge, or one, sort of assumes the other, subsumes the other. You have two management teams, and then one way or another, now you're left with one. So one entire management team is gone, right? Now, if this was set up so that if you are the CEO or you're a member of the executive management team, and you know that if you are acquired or you merge, there's a high likelihood of you being let go and then you lose everything, you're probably not going to want to merge or be acquired by anyone, right? Because it would be very bad for you. You lose your job, and then you lose all these long-term incentives that you had been promised and you've been working towards, right? So what they do is they write a bunch of clauses in that colloquially are called, golden parachutes, where it says, like, if you're acquired or anything like that, don't worry, you won't forfeit all this stuff and you'll get this sort of severance package or something like that. So they put all that stuff in there. So the whole purpose of all these tiers of compensation is to align the incentives of the CEO and executive officers to care about the corporation as if they were owners, as if they owned it outright. Very hard to do. Very, very hard to do, because the way you normally do this is you have to sort of go through every possible scenario where somebody could abuse the performance pay or any other pay package. You think like, okay, how could someone abuse this? For example, in the case of Enron, which, we all remember what happened there, a lot of the executives were paid where a lot of their compensation was weighted by the stock price. It was heavily dependent on the stock price. Now, the reasoning was that if the executives run the company well and they increase the value of the company, presumably the stock price will go up, okay, because the public will view that company as, being very valuable, so they will want to buy shares in it, so the stock price will go up. Okay, that's the reasoning. However, think about it for a second. How could you abuse that? Well, what you could do is you could not actually run the company in a way that makes it valuable, but you could fool the public into thinking that the company was very valuable. Maybe you were doing all kinds of fraud, all kinds of shenanigans where you were saying you were making all this money when you really weren't, right? So there's deception there, there's deceit. And so the public believes that, wow, you're really successful. So they buy lots of shares, the stock price goes up, right? The executives get paid a lot. Maybe they cash out and leave the company. And then it may be quickly discovered that, it turns out that company didn't make that much money. It was all just a fraud. And the share price then collapses. But that's okay because the executives are safely out of it. They've got their cash. They've taken all their shares. They've sold all their shares, and they're out of it. So it was like, obviously that's abuse of what this was set up to do. So compensation committees, they have experts usually that advise them, compensation experts, where they sort of run through almost every possible scenario where you could doctor this, you could fiddle with this system for your own personal gain. And they put things in place to counter all that, right? Like, for example, any kind of metric that your pay is based on, you can sort of try and fudge that metric. You could redefine how that metric is measured, or you can, obfuscate what's really going on so that it looks like that metric is performing well, but really it's not. There's all kinds of way around stuff. So compensation committees, they have to think like, if I was going to manipulate this system, all this performance pay, how would I do it? What would I do? And what can we do to detect that and prevent that from happening? So it gets very complicated. I've only been involved with very small company stuff, where you've got 3 board members, this kind of thing. And, but I mean, from what I know about this stuff, it gets insanely complicated. You can have you need almost like a PhD in finance to understand some of the ways that you can fudge with some of this stuff. It's almost like in the realm of financial engineering. At least that's how it's always seemed to me. So it's basically about, aligning incentives and accountability. You want the person in charge of your baby, the CEO, to run your baby, run your company, the way you yourself would do it. You want them to care as much about it as you do, even beyond, their longevity. They might only be there for 5 years, but you want them to have put in place things that set up the company for success far beyond that. It's not all about them, it's about the company. I believe a lot of this stuff should come downstream, to be honest, to more junior employees. I think a lot of times there's reasons why it doesn't that are legitimate. However, sometimes I think that there's reasons why, they're pretty bad reasons why people aren't trying to incorporate more of this into the mid-level employees or even lower-level employees. I think there could be a lot to be gained. If you can get your mid-level and lower-level employees to care about their organization, to give them incentives to care about how it's doing, I think that really helps in certain situations, definitely. That's probably a good place to stop for my monologue. I'm going to briefly open it up to questions. If any of you guys are here and you're awake and you've got questions about any of this stuff, get in the chat. There's a chat box that if you are a subscriber to my channel, you should be able to get in there and ask me anything or I guess say anything you want. I'll briefly open that up if there's anyone who wants to do that. I've already actually set the title of next week's episode, and I don't have that in front of me, but I believe it was talking about the audit committee. So we were talking about the compensation committee today, and it'll be the audit committee next time. Because the flip side of all this stuff is the oversight. It's one thing to, sort of put incentives in place. It's another thing to do the controlling function, to check up on whether these incentives are working and counter any attempts to sort of circumlocute them and, get around them and negate them. That's the flip side of this. I touched a little bit on that last week. I'd like to go into more of it again, because this stuff really sets up the situation for acquiring a company, understanding who's in charge, what their incentives are. And usually there's a transition period where you acquire a company, and usually you transition a lot of the old management out and maybe transition in some new management. So this stuff is very important, and it's very important to understand it, and it will definitely play a role. How many times have people sold a company or someone has acquired a company thinking that it's very valuable, only to discover that a lot of that value was inflated? That happens pretty often. And their turnaround efforts or efforts to improve it don't really work because they walked into something that they weren't expecting. That's where understanding all this stuff really comes into play. Okay, we're not getting a lot of questions, but that's cool. I honestly didn't know if anyone was interested in this stuff. I'm interested in this stuff. I think that there's a lot of potential to apply these concepts in other areas. But I see there's 18 people. Thank you for being here. I'm probably going to wind this down now. But I will be back next week at the same time with another episode of Private Equity Rundown. My intention is to cover some of these principles of how corporations are set up. As I bump my mic. Yeah, here's my mic. And then start incorporating the discussion into talking about actual private equity, the acquisition of companies, why people do it, how it goes, what their perspective is, what are the things they try and do with it, and their reasoning, and how it works out. So it's part of a big, long sort of arc that we're going to be doing. Thanks very much. You guys are awesome. I will see you next week. I will be back actually in about 25 minutes with a regular live stream on how to get a job, my usual thing. How do you say that? Al Monk says, how do I become a CEO? Oh, there's many ways. It's like saying, how do I become a sewage treatment attendant? There's many different ways of doing it. One is to found your own company. That would be the most direct way. Two would be to sort of rise through the ranks to the point where you are an authority in your field, whatever your field is, and you are at the management level, certainly the mid-level, and preferably the upper middle level or executive level, where you understand like how to create that type of business, where the value comes from. It amounts almost, in my experience, it amounts almost to founding the company, creating it yourself, because you understand, not just how to create the thing, whether it's a product or service, you also understand how to sell it, who to sell it to. You may have connections to the world of customers, okay, all your prospects. You understand, like, in great detail, what the value is that you can sell, okay? So what that means is that you can grow the business. You understand, like, this is why people come to you for this thing. This is who they are. This is what they're looking for. This is how they think. This is what we do. This is what we can offer. This is how we create it, right? You understand enough of that where you can lead it. So that means you can make decisions that will result in growth, right? More business. There's more demand that you can meet, right? So knowing that makes you valuable. So there are a variety of reasons why someone would want to hire you, okay? Maybe they buy and sell businesses in the same way that, a layperson might buy and sell cars or things on eBay. You buy something, you improve it, you sell it, you make a profit, right? Well, high net worth individuals and institutional investors and things, they buy businesses. And, they understand the finance of it, like money in to buy it, and then I improve it, and then I sell it. But they're not in the business of doing what that company does. For example, you put your money in the bank, maybe, and the bank takes it and invests it in all kinds of different things kind of behind your back. They kind of sometimes tell you about it. This is where your money is going. It's buying, commodities, or it's buying shares, or it's buying bonds, or, whatever, right? And then they kind of manage it for you, and then they buy stuff and sell stuff, and then your wealth goes up, it increases, right? So the bank manager might understand, like, buying and selling shares in blue chip companies, but the bank manager doesn't understand how to run a blue chip company, right? Well, that's where you come in. If you work in that business and you understand the business, and people trust you in the sense that they know you've been around for a long time. You know a lot of people in that industry, in that business. They all know you're legit. They all have dealt with you, so you have a good reputation. You're easy to deal with. Then you can be approached by people who buy and sell businesses, for example. And if they have bought a new business, they may say, okay, I've just bought this thing, but I need someone to run it. Now, I understand that you have worked in this business your whole career. Everybody tells me you're the person to go to if you have questions about it or how it's done. So would you come and work for me? and I'll put you in charge of this. So you'll be the CEO and you run it on my behalf. That's another way of doing it, right? So one way or another, you have to have that knowledge. Now, either you get it yourself by creating your own thing, or you rise through the ranks of, an employer or something like that, to get to that point where you understand it. Those are probably the two most popular ways that I know of to become a CEO specifically, if that's what you want. Other times it's just seniority. Like if it's a very mature industry where, let's face it, there's not a lot happening. The way it was run 50 years ago is the way it's run now, and probably will stay the same for the next 50 years. Then sometimes it's almost a seniority thing that kind of perpetuates all the way up to the top, unfortunately. Most people don't usually make good CEOs, but, they've been around so long that in theory, they should know the stuff. Sometimes it works out, sometimes it doesn't. But there's different methods. These are some of them. Yeah, like this is something I learned in my 20s and 30s. It's like, how you would buy, a car or something. There's high net worth individuals that, they get a bunch of money and they don't just buy a car. They get a bunch of money and they buy a gas station, or they buy, a franchise of KFC or Subway or Burger King, or, like one of those sort of like food franchises. Now, do they work behind the counter of the KFC? No. They hire a store manager to run that store for them, right? You know what I mean? So it's like there's some people that will just buy a gas station and will say, okay, hey, I need you to run my gas station. That means I have to trust you. You can run this thing into the ground, if you wanted to. That's why I have to trust you. And maybe they put you in charge of one gas station. Maybe they buy a second one a year later, and then a third and a fourth and a fifth. And next thing you know, you're the CEO of a string of gas stations, right? You are not the primary owner of it. The owner owns them all, but you're running it for them, right? That's the role of a CEO. So you can become active in that world, and networking is a big part of it. People need to be aware of you. They need to have heard of you. They need to understand that, that you're legit, because every player in that local industry knows of you, whether they are competitors or partners or suppliers or, regulators. Like, they all can attest. Yeah, this person knows their stuff. They're great to deal with, and they've been around for a while. Everybody thinks they're great. And they did help build up that business quite a bit. So getting the word out there is kind of essential in one way, shape, or form. So anyway, I could go on, but hopefully that answers your question. That's a great question. We could certainly do an entire episode on just answering that. Anyway, I'm going to be back in 15 minutes for the Honest HR Nitrous live stream. So if you want to stick around for that. Other than that, I will see you same time next week. You guys are awesome. Check out my courses. If you want to learn business from me or anything, check out that course. Best bang for the buck around. And I will see you soon. Take care.